before we bought the stocks. And so we shouldn't really be too concerned with short-term prices. We should just understand when you're investing in deep value, patience, and your ability to handle volatility is the price you pay for the big returns that the market in general cannot stomach. It's now time to talk about how we manage our portfolio. When most people hear the words portfolio management, they will picture someone at a desk, probably surrounded by screens with flashing green and red numbers all around them, like something you'd see on Wall Street. Now, that's from the world of trading and not the world of investing. Even if our portfolio is comprised of over 100 positions, it shouldn't be difficult to manage, and here's why. Unless something fundamental in one of our theses changes, then there's no real need to do much. So pick Bitcoin, for example. We first recommended Bitcoin when it was $400 or so back in, 2014, something like that. And we got out in 2021 when it was $50-something thousand. Now, I won't go into the reasoning for us doing that here, but the point is, it wasn't the price that affected our decision, it was the thesis and the fact that we believed going forward there were other things we could invest in that would give us similar or better returns without the same amount of risk we'd be having holding Bitcoin. And it's the same with any of our themes. We don't get too clever by focusing on the minutiae of our portfolio, especially when it comes to how much individual stocks go up and down. Remember, a rising tide lifts all boats. We're investing with the tide in mind, not the individual boats, because getting the tide right is where the money is. Spending a lot of time on monitoring each individual position in our portfolio, which might be 1 or 2% of our total portfolio, is not going to materially grow our wealth compared with making sure that we're getting the big picture right. Now, of course, if something goes stupidly wrong with some of our picks, that's different. An example being if you wanted to invest in oil and gas and you bought BP stock, and then BP turned around and said that they were transitioning to clean energy, then you're no longer investing in oil and gas with that position. So you'd go and find another company that was giving you exposure to oil and gas to replace BP with. We do still look at prices of individual stocks we hold, but really only when there are anomalies and changes in the fundamentals. What we're not doing is expecting every position to constantly trend upwards, and we're not getting worried when each one doesn't. Given we're holding many stocks as a basket in one industry, we should be able to tell whether one position is diverging from the rest of the basket. And if it's a big divergence, we'll go in and check it out, try and work out why. We'll take action only if we're certain we need to. In essence, we're not spending so much time monitoring each stock we've chosen. Instead, we spend more of our time monitoring our thesis and making sure that we've got exposure to as good an asymmetry as there is available to us. So you can think of this like an ETF. You don't go and check the prices of each individual holding in an ETF each day, you just check the ETF. Besides which, we should have done all of our worrying and due diligence in the selection process before we bought the stocks. And so we shouldn't really be too concerned with short-term prices. We should just understand that when you're investing in deep value, patience, and your ability to handle volatility is the price you pay for the big returns that the market in general cannot stomach. Coming to grips with this is essential for good portfolio management, doesn't matter what you're doing, and staying sane. Now comes the more difficult part, which is knowing when to sell. A common mistake investors make is confusing volatility, or luck even, with their thesis working out. If you've invested in a position, say a copper miner for example, and it goes up 100% in a few months, what should you do? Well, there are a few things that can help us reach a decision, but none of them are to do with how much you're up or down. First of all, think about the context and the timelines here. If miners have been in a bear market for the best part of a decade, maybe more, then a few months is a relatively short amount of time in relation to what you'd expect a bull market to look like. Other things to consider are what's changed. If you bought a company at $10 because it was incredibly cheap and their revenue tripled and it's now $20, do you sell it? Well, no, because it's actually cheaper on a relative basis than what you bought it for. It'll have a lower price to earnings ratio, for example. In other words, we should be worrying about whether what we hold is cheap or whether it's expensive. We want to be thinking like investors, not traders. We want to think about the value of something and not its price. We also have to remind ourselves that if we want to achieve truly huge returns, the bull runs we want to get in front of can last many years, maybe even over a decade. And so hanging on is probably actually the hardest part. Just look at a chart of Amazon to see what the annualized returns are if you'd invested just after the GFC and held for over a decade. Now think about how much you'd kick yourself if you sold when it first returned 100%. Now there's a more conservative strategy that many investors use, indeed some insider members use this, which is taking the initial capital or a portion of it out at certain milestones. So for example, if a stock you buy reaches 100% returns, then maybe taking out all the initial capital so that you're guaranteed not to lose money on the trade, and then you can leave the rest in to run. That's a perfectly fine thing to do if you want, and you understand the reasons for you doing so. For example, maybe you're an older person and don't want to take as much risk as we're comfortable with. So, we don't do that because again, it involves too much of our time. We're not going to let our winners run as much. And if we've done our jobs right, we shouldn't really need to do any of that because our strategy allows for not fiddling around with individual positions. So what we're really getting at here is our view that when you're trying to work out when to sell something, its price relative to what you bought it at is irrelevant. There are many, many, many other things to think about when deciding whether to sell anything. For example, can you hold something else that will get you better returns? If you believe so, then that's a legitimate reason. Then there's the old trick of looking at what you have in your portfolio and asking whether you'd buy it, because that's just another way of saying, is this cheap? You also want to think about the wider world. So what are capital flows doing? Has there been an increasing amount of coverage in the media? Are newsletter writers flogging it? Is it being added to ETFs? Are there mergers and acquisitions happening in the sector? In other words, what you want to do is try and use as many data points as you can possibly find to work out if something's cheap or if it's expensive, and not look at price in isolation. Remember, you care a whole lot about how much you bought something for, but the market doesn't. So it's purely emotions, has nothing to do with reality. So don't get in the way of yourself locking in thousands of % gains. Finding tactics, strategies for dealing with the emotions behind your investments is absolutely essential. At the end of the day, we're all human, and that means we're all imperfect. Imagining that you didn't own your investments, that you were just looking at them and then asking your question, would I buy this? It takes you out of the emotional position of holding the investment and all the baggage that comes with that, and gets you back in the rational mind of an investor. Now, everything published in the insider portfolios are rated buy, and that means at whatever point you join the service, you can find all the positions that we own and recommend. And when either a thesis changes or one of our themes no longer represents deep value or is no longer asymmetric for whatever reason, then we sell, we notify members, and we redeploy that capital across the portfolio or into something completely new. So, the key takeaways for how we manage our portfolio are: focus on the thesis instead of the individual positions. You worried about the individual positions earlier. Remember, we're looking at the tide and not the individual boats on it. Keep an eye out for red flags. So if your oil company turns around and says it's now becoming a wind company, replace it as soon as possible. Don't look at a company's price in isolation. Compare it with the other companies that you hold's charts, compare it with its previous high, compare it with many things to establish whether it's still cheap. When you think a company is no longer cheap, sell it and replace it with things that are cheap. Instead of focusing on prices, focus instead on valuations. And when it's clear valuations are high, then it's time to think about getting out and back into deep value. We don't need any technical analysis. We don't need stop losses for what we're doing. We're instead using probability instead of believing we're going to outsmart the market. We're using probability to grow our wealth safely in a very uncertain world. On behalf of the team, thanks for sticking with us during this series, and best of luck out there.